Hello, everyone, and welcome to your Onchain update for the 10th of May. So, we saw a pretty interesting event happen yesterday, or the last couple of days, which has been obviously this extraordinarily high fee spike due to people putting, essentially JSON text files at extremely high fee rates onto the Bitcoin blockchain. So, what we saw is that fees actually broke above the block subsidy, which is 6.25 BTC. And we essentially saw the blocks are being mined with more than that in terms of fees being paid. So, essentially, a doubling of the revenue that any miner who was lucky enough to get that block went home with. So, we're going to focus a little bit on that in the second half of this session. But probably of more interest is what's going on in terms of the macro market, supply dynamics, things like that. Particularly, we're going to focus on our entities, and we're also going to look at exchanges because I think they're basically your two cohort buckets, right? If coins aren't in a Shrimp's wallet, they're probably on an exchange. So just looking at what appears to be a kind of stagnant, flat, not much happening type environment. So we're going to have a look at those types of metrics, and then we'll close out by looking a bit more into the block subsidy, the fees, and some of the impacts on miners, because there are some fun things going on there too. Okay, so starting off with our entities. So this here, remember when we're looking at these charts, there's two types of charts here. This one is essentially the balance. We're looking at the shrimp cohort. So we're looking at the balance held by shrimp in the line or crabs or whatever entity we're looking at. And down the bottom here is their 30-day net position change. So we've talked about this over the last several months, really, since probably since FTX was probably when these metrics started to evolve. And you can see that we've had very, very significant spikes higher. This one here was on the same order of magnitude, 55,000 BTC a month as the 2017 peak, which was the previous high. Post FTX, just blew everything out of the water, right? 85,000 BTC a month. And what you can see just on a macro scale, this is in a net uptrend, right? We are seeing an elevated over a sustained period of time, really since this time last year, the last 12 months. If you can believe it, 12 months ago, Luna was in the process of imploding. So essentially, we've seen a regime of higher than average shrimp buying, right? Which is good to see. It is what you want to see. I'm personally a big fan of the shrimp holding more and more. I think it's like 6.7% of the supply. And obviously, shrimp accounts for people who have good privacy practices. So you may have more than one BTC because you've been stacking sats for a long time. But because you're doing it in less than one BTC chunks and you never combine UTXOs, all of your coins would essentially show up in here. So it's kind of a bit of a catch-all. And again, these things don't need to be perfectly precise. Now, the real takeaway here is this is kind of where things start to get a bit interesting. Note that the shrimp are still in a nice, healthy uptrend, fairly substantial. Crabs are starting to come down a little bit. There's a little bit less going on. They're down to, what is this, 5,000 BTC a month. It's not that much. Now, by the way, this shrimp cohort here, this is equal to the mining block reward, right? So the shrimp are essentially consuming 100% of the coins that are mined. Crabs, on the other hand, they are not, right? What we're seeing here in this particular cohort, they are not consuming as many coins. That's actually declining. 5,000 is getting smaller. And you can see that this is starting to flatten out in their total balance. Now, this is the second type of metric we cover here. It's a nice way to normalize things. I mentioned the mining, right? 900 per day. Let's multiply that across the whole year. How many coins get mined in the course of a year, and thus how much did a entity's balance change, right? So the normalization factor is how many mined supplies have they consumed. Now, the shrimp and the crabs have seen over 100%. So basically, between those two over the last year, these massive spikes across these cohorts have essentially consumed all of the coins that were mined over the last year. Pretty remarkable stuff. When we look at it on the shrimp cohort, this is 10 to 100. They're at 75%. But remember, this is a 1 year lag metric. It's essentially looking at what's the aggregate change in share. It's not really so much about in the immediate weeds. That's kind of what these metrics are looking at. So if we then start looking at things like the fish to the sharks, these are 10 BTC all the way up to 1,000. Pretty flat, really. I mean, it's not negative, but it's pretty flat. Now, by the way, this is the scale of these things. You got to remember that shrimps and crabs, they just literally do not have as much coin as the larger cohorts. These larger cohorts, even these tiny little bumps here, this is still 22,000 BTC, which is more than the crabs are accumulating at the moment, right? This decline here is coming down from 17, so even the peak here, or 25. So this peak is the same as this tiny little blip here for the fish and the sharks, right? They are just a much larger entity. their balance is substantially bigger on a relative scale. Here we are actually breaking those down. So you can see that fish are still adding to their balance. And the shark cohorts, yeah, it's kind of a bit flat over here. So you can kind of see that on a relative scale, relative to the amount of contribution, how active these entities typically are, they're less active right now. So, but also note that the fish cohort is larger than the shark cohort in terms of relative scale. So the kind of view here is that, and we're seeing this, it's an illiquid market. There are less institutional traders floating around. There are less high net worth individuals. The demand is still there for Bitcoin as a, man, the world's kind of a bit crazy right now. This asset makes sense. But there's less demand in my kind of read for people who are like, yes, we're going to put on this position and we're going to hold this market making. We're going to put these option strategies on. And there's a bit less of the Bitcoin is now a tradable asset type thing. And I think that's applicable across many markets, to be perfectly frank. I think we've seen liquidity really draining from a lot of parts of the market. It remains to be seen whether that does start to really reverse. But at the moment, we're in a bit of an illiquid type market. We see this even in treasury markets, which is kind of wild stuff. And then on the whale cohorts, they are also pretty flat on a relative basis. There's not much going on there either. So overall, all of these entities are kind of relatively flat. There's not a great deal going on. You can see what I mean by it's a bit kind of, there's not really much happening. And after a 70% rise, I mean, to me personally, as much as I want to see Bitcoin go up, I also wouldn't mind another bite of the cherry. So a bit of a pullback there wouldn't really make me too upset. My macro bias still remains that I think we're probably in a longer term uptrend. But in the short term, I wouldn't be surprised, and I would actually be personally a buyer down there at like 24, 25,000. I think that would be healthy. I think it would wash a few people out. And, I still believe there's a lot of support down there, certainly based on the supply perspective. So now just moving across and looking at the exchanges, and we'll look at a couple of metrics here. Exchange balances is kind of creeping higher, right? From 11 point, what is this? Just before the start of the year, 11.8% to 12%. So 0.2% of the supply has rolled into exchanges, which, in the macro scale of things, it's kind of insignificant. Coinbase, pretty much flat. Very, very little going on. Binance has seen a little bit of a pullback recently in terms of coins, but again, it's mostly inflows. Binance just seems to be up only. People just do not seem to be shaken. Kraken, kind of flat. That's Bitfinex. Sorry, Kraken is actually seeing net outflows and has been for some time. What we're seeing here for Bitfinex is they're pretty much flat. There's just not that much happening. Here on a relative scale, exchange deposits and withdrawals, this is BTC volume. You can see that we're this is kind of a very, very broad. There's lots of action going on in the bull. Here we've really tapered down to quite a small fraction of what we're used to seeing. Now, to be perfectly honest, this chart here can be a bit hard to kind of read. A better way to view this is definitely this one. Exchange volume momentum. Take our inflows, take our outflows, compare the monthly to the yearly. Simple tool, tells us whether there's more or less activity. It's kind of all you need to know, to be perfectly honest. We had a bit of upwards momentum as we pushed up to 30K. It is starting to pull back. So there's just not a lot happening. It's very quiet. I'm not bearish, but I'm also not kind of hyper enthused. It's just kind of working through some of the kinks at the moment. It's a bit of a consolidation. There isn't a great deal of activity, which is, you could argue, a bit more of a bearish case. But that's just my general read at the moment. Now, just to give you a bit of context on pricing models, I actually quite like this model. I think in terms of tracking a bit of recency bias, the older age bands, right? What we're looking at here is the average price of exchange withdrawals. I don't particularly care too much about the all-time, the 2017 class, the 2018 class. They're kind of interesting to see how far down we go in terms of how many people are underwater. But aside from a bit of a novelty, Now, where I provide a little bit more weight is to these more recent ones, the 2022, and actually I haven't put the label here, but this pink one here is the 2023. 2023, we got a nice, actually, let's zoom right in on this. So for a bit of context, here's 2021 class up the top, the most underwater, right? People who bought the top. 2022 started and was essentially averaging down through the bear. We are hovering just above that at 26,400. 2023 obviously starts at the bottom, right? Not a bad place to be getting in. And it is currently hovering down here at 24,300. So again, a quick trip down to kind of test our cost basis for this year, I'm not mad at. That's kind of the short-term holder basis as well. That 24, 25,000 level, I think that would be a nice retest. I would like to actually see that. I would obviously like to see a swift reversal following that. But a bit of a retest down to that level, I'm positive that you run some Fibonacci levels. I haven't done it myself, but if you did a Fibonacci level, you'll find that's like the 0.50 or the 61.8. These things always tend to correspond. It's kind of neat how it does that. And what's this one here? This one here is all the different exchanges. So looking at Coinbase and Binance, the two biggest, their exchange average price is around 21,000. So that's a bit on the lower side of where I would expect to be, but also it's kind of, I mean, there's a stack of support down there and many things. So just gives us a bit of a range in terms of estimating some downside and potentially looking for some opportunities. So moving on to the mining sector. So we kind of covered the mechanics of what was going on in the video last week. Really, this is kind of the main chart that I want to highlight. This is looking at, in the blue curve is the block subsidy. So what I've essentially done is used Workbench to basically build out the Bitcoin supply formula. Right, so we've got 50 BTC times 0.5 to the power of what epoch are we in, right? In epoch 0, it's going to be times 0.5 to the 0, which is 1, which means it's 50. In the first epoch, or after the first halving, it'll go down to 25. So it's basically literally halving times 0.5 times the amount of epochs that take place, or to the power of how many epochs there are. Now that's a bit of formality, but what's really interesting here is this is our average fee. So it's average fee per block. So we know the miners get 50 back here, 25, 12.5, 6.25. This is how much the block subsidy is. Now you can see that the orange here, which is the average fee paid per block, broke above the block subsidy 1, 2, 3, 4, and 5 times ever in the history of Bitcoin. So when you look at something like that, and by the way, what you'll notice with all of these is that it broke above and then gone, broke above, gone, broke above, gone. Like, this thing doesn't stick around. So my expectation, based on history, based on the 5 data points that we now have, or 4 technically, we are most likely to see fees come back down. High fees is a great cure for high fees because, I mean, I certainly am going to wait till fees come down before I transact. This is kind of the nature of the beast, right? So fees will go up, they will come down. I expect that we're probably in a higher fee regime moving forwards. It does probably, the lessons that you learned, probably seeing over the last couple of days, fees being high, gives you a bit of momentum to think about UTXO consolidation, right? Do you when you're dollar cost averaging, I saw someone on Twitter, I don't know how this happened. Some people have got UTXOs for like 5,000 sats. You're never going to be able to spend those. So, and again, UTXO consolidation is a bit of an art because you don't want to, obviously, there's privacy implications and all that stuff. You don't want to combine all of your UTXOs into a single one. There's all these kind of things there. But what you also don't want is a UTXO that's going to become dust in a high fee environment, because at the peak of a raging bull market, we may see fees like we did over the last couple of days. So at the exact time that you may want to take some chips off the table, it may cost you a couple of $100 to send it. So just thinking about that in advance, Bitcoin will charge you a fee in BTC depending on how big your data footprint is. The more inputs, UTXO inputs that you're spending, the higher the fee. If you're not on using SegWit, your addresses should be BC something rather than 1 or 3, which are the legacy types. You should really be on SegWit if you aren't already. So upgrading all of your UTXOs to a SegWit UTXO or a SegWit wallet is a much better approach in terms of fees. You get like 40, 50% fee reduction. There's a couple of things you can do there just to prepare yourself. We've just seen a high fee environment. We're going to see it again. Prepare yourself for what could be a pretty chaotic raging bull market at some point in the future. And just thinking about those things in advance. It's just that kind of daily reminder, or evently reminder that tells you to just pay attention to that. So the last thing I want to focus on is mining incomes. We're looking at the total miner revenue. We saw mining revenue pick up quite substantially. So they are something like 125% off their lows. Significant boost to mining revenues, quite substantial. I think we're up here, it's about 36 million per day. After a seriously cold winter in 2022, the miners must be absolutely chuffed to be finally getting paid for the first time in a long time. We'll see how long it lasts. Hash price, right? This is the dollars earned per hash. This is just the angriest down only log chart that's ever existed. It only gets more expensive to mine Bitcoin, with the exception of the occasional relief rally, right? They've finally seen an uptick. This is up to $100 per exahash, up from 58. So there you go. It's about 100%. Not quite measuring the bottom, but about 100% from the bottom in terms of hash price. Now, this is factoring in that difficulty is also increasing at the same time. So, I mean, it is a brutal industry, mining. It really is. And the last thing is when we're looking at mining balances have stabilized. So finally, they've been able to actually stop selling their coins and stop liquidating because they have to. The blue curve here is the percent of how much of their mined income they're spending. And you can see this red line here is essentially 100%. Finally, they've recovered from a period where they were selling well and above, actually liquidating their treasuries, where they were spending more than what they were mining. They've finally moved back to a period where they're at the very least holding on to just a little bit. So again, these miners will have accumulated a very small amount over the last couple of days. I would be surprised if those kind of good times stick around for very long. But hey, who knows? Maybe this is a new normal, but I'm certainly not in the camp of this time is different. So I do expect fees to come back down. I wouldn't be surprised if it's in the next couple of days. But I do expect we will see a high fee environment moving forward, and it is going to drive innovation. It's going to drive people to just consider things like, Lightning Network, how are you managing your UTXOs, all this kind of stuff. So certainly worth thinking about it before the chaos happens. Anyway, hopefully that's a useful update, and I will see you in the next one. Cheers.